Okay, everyone, welcome to another episode of Point of More Returns. I am your gracious host, the Masked Investor. And with me is our gracious co-host, Walt Fair, the one and only. Walt Fair, let's talk to him. What's been going on? What's new around
Yeah,
your
man.
way?
Yeah. Thanks for introing. A lot is going on. I know I say that like every single podcast, but it's always stuff going on, man. So yeah, talking about deals today. You're in the middle of a deal. I've been in the middle of some deals, close one or so, and yeah, we want to talk about what's going on in the market today as well.
Yes, we do. If you've been following along in markets, if you've been actively looking for real estate, small businesses, or even just buying private investments or public equity, definitely have seen ups and downs in the market, some uncertainty, and just kind of wondering what's the best strategy to go and how to make sense of it all. And so we decided, with this quarterly update that we do around this time, to kind of delve into the numbers and just offer some insights from what we've seen in the field and from conversations with professionals that we've had, and just kind of dispel the wisdom, provide the analysis that you won't find on your typical show, right? And so to begin, we want to start off with the BizBuySell Insight Report for private market buyers. This has always been a really good report that comes out that gives some good tidbits. Sometimes there's some, insights that you may disagree with, and this one's not different. And so we're just going to dig in and kind of share our take on it. But the first thing I'd like to kind of go over here is that at the top part of the transaction, if you've been digging around, you, like I and others, may have noticed that doesn't seem like there's as many listings as there used to be in past periods. And it confirmed that that was just true. The amount of listings, total businesses that changed hands in quarter two 2025 is down 4% from the same period of quarter two 2024. And that includes the number of listings that are all available on the marketplaces. And so with that, you would think that that would probably affect prices and cause more competition. But as the listings have gone away, so have buyers as well. And a lot of it you're just trying to due to the uncertainty due to the new administration, right? You're going to see changes. And as a result, as people try to digest what's been happening, they're going to sit on the sideline on their hands and take a pause until they can make sense of what's going on and what direction to do and what's the best move going forward. One of those things that we're noticing that they said is that nearly half of surveyed owners report that tariffs have increased their costs. 55% say inflation has yet to ease, and 66% have raised prices as a result. And so the customer reactions have been mixed. So some are just seeing varying results from prices. Some of them are getting them through. Some of them haven't been able to. And so as those market pressures continue to swell, and it doesn't look like they're abating anytime soon, the environment is definitely affecting deals. And so you're seeing, in quarter two, there was $1.9 billion in total enterprise value. That's down 4% year over year and 6% from quarter one. And the median sale price fell as a result too to $352,000. Median cash flow declined 2.6%. Revenue kind of held steady. And 68% of small business owners say that their customers are being more selective, focuses on essentials and cutting back on discretionary spending, and it's prompting them to delay, react, and return. So they're delaying hiring, scaling back growth plans, and even postponing expansion efforts. And so just going to pull there and just kind of see what that kind of says to you, right? And for me, the first thing that I take away from that is that, as I mentioned before, people are just putting things on pause and just sitting back and waiting, which it doesn't always seem to be when you're fearful, you always want to sit back and wait. Sometimes that can be good, but sometimes that can be harmful too, right? Because, in a period where action is happening, inaction seems like a good thing. Like you can hit a pause button on the game and just take a breath and come back to the game with the new strategy. But that doesn't seem like that's the case here, because while they're sitting pause, the revenue, their business is becoming less profitable by the day. And so there's only kind of two levers you can do on that. You either grow revenues or start cutting cost. And if you're not doing either, you're just losing traction altogether. What would you say about that, both fair? Just that's something that you would.
Yeah, well said, man. I had a couple of comments and questions for you. Like really great insights on this. For someone on the outside looking in, I'm not looking to buy a business just yet, but I love learning more and like reading up on these types of like articles or whatnot. Do you, in terms of, we were just saying before we got on the pod about like just the idea of market equilibrium in terms of it. Equilibrium meaning it's balance between buyers and sellers. So there have been less listings, so there are less sellers, but it's also less buyers. So do you think that's kind of almost like a parity where it's like it's still at a market equilibrium, or would you say it's still more sellers than buyers? So that was the cause of like less transactions.
Yeah, I wouldn't say there's more sellers than buyers, but the overarching thing is, if there's less buyers in a pool, there's just less demand, and as a result, less demand is just naturally going to bring things down, because you got to think there's only a percentage that are actually qualified to buy into certain businesses, and then it's kind of like the pyramid effect, where you got a lot of people down there at the bottom who can maybe buy, and then up there at the top, it's kind of not as many people kicking the tires, so that can affect your deal price too. But one thing that stood out is that they said 45% of the buyers in the market are now corporate refugees, which is people just tired of being employees. I don't know if it's just being tired. I think it's also a mix of people who just got laid off too, right? And I guess you could say tired of being employees, because I got laid off again. I don't want to go through this again. I don't want to put my fate in someone else's hand. Let me go buy a business, and then I can bet on myself. And so you got that, and then there's more buyers pooling resources, which is something we mentioned way back last year, a few years ago, is that consolidation seems like the play now. Is that you're not going to be able to kind of go out as a solo buyer or a solopreneur as readily as in the past. You're going to have to start teaming up if you're going to be competitive, because it's just that type of environment where now, even, when we first started looking at deals, in the aughts, we'd come to a deal and we'd be like maybe there'd be another person looking at it, but oftentimes we're the only person looking at it. And now that's just not the case. Mm-hmm. You'll go to a deal and you're guaranteed there's somebody else that's kicked the tires on it. Now, they may not be able to do it for whatever reason, but the fact that there's somebody there just kind of tells you what the state of things are. But I know, some people who've been teaming up with friends and trying to look at deals and kick things because they couldn't swing it alone. Even myself, I had to partner up on this deal that I'm doing, because I could do a lot of smaller deals, but just from a time of efficiency standpoint, it doesn't make sense to do a small deal where I'm still have to be the sole proprietor and running the business, and not making as much as I could, or I'm making what I could if I teamed up with somebody, and I could be somewhat semi-absentee, or divvy up the labor and take less of a time suck from it, where I have some time, but
Can I stop
just about as much.
Yeah. Totally agree. Really great insight. So I just want to add, I stopped you because I wanted to add to that point, because in the article it said something about median sales price fell 6% year over year to 352,000. So we talked about that a lot, and I won't go into a lot of detail because we have other pods about this topic specifically. But I would have thought like the median sales price would be a little bit more. I wouldn't have guessed 352,000. Those are still, in the grand scheme of things, like relatively small deals. So to your point about being solopreneurs or, owned by two partners or whatever, is that probably would fall a little bit more in line with that. Someone, like you said, a corporate refugee who's looking at just, okay, let me run my own business. I can set my own hours. I can just, work whenever I set my own hours and like have autonomy over myself and just, run the business that way. Or either have like some part-time employees or something along those lines. Do you think this changes over the next couple of years? It could be administration. It could just be the jobs and employment. Like, what do you think happens over the next, 12 to 18 months in terms of like the number of buyers, number of sellers, like transaction, like closing price? What do you think happens in the next 12, 18 months if you had a crystal ball?
That's interesting because I was thinking about that earlier, and I've been talking with some other people about it too. We've been talking about, there's an increase in the number of search funds and MBAs and people who are going to school with the strict purpose of just coming out and buying a business when they get out.
ETA,
and running
right?
it. Yeah. They actually have classes that are teaching that now. And so I imagine that would increase the buyer pool. But on the flip side, too, is that you're looking at the number of college graduates who are going without jobs once they graduate, too. So they don't have access to the capital to even start doing this unless maybe they trip with a search fund or their parents leave them some money, or they can maybe offer some sweat equity or just get really creative in the financing process when they're searching for a business. So it's two levers that are kind of pulling different directions. So it's hard to say which one wins out. And I don't really know for sure which one wins out, because it also, you mentioned some of these businesses aren't going to make it either, right? With the ones that are sitting on their hands and letting the costs kind of eat away at their margins, or who just won't be able to pivot anyway because, they're going to have to shut down because it just becomes too prohibitive for them to run the business. They have to fold up the shop. So there's a shift that's underway right now that I think will have some permanent repercussions in the market moving forward. But in terms of what actually happens, it's just hard to say because, like they say, it's just too many factors that are weighing right now that could bring this thing either way, I think. But I do know that it is about having cash, which kind of shifts to the next point that I wanted to make, is that, there's some changes to the SBA lending rules that happened earlier in the year. And if you paid attention, if you've been listening to the show, we've talked about it previously before, but basically the SBA changed their lending rules. And so now, the sellers will have to basically guarantee the loan for somebody to buy them out if they offer, if the seller is forced to either roll over some equity in the business of any sort. So anybody who has any equity in the deal, they have to be in guarantor on the loan. So even if I put $2 in, I got to help co-guarantee this whole entire loan. And so that's going to be interesting because a lot of sellers naturally are hesitant to guarantee a loan for somebody they just met a couple of weeks ago, came up saying, hey, I want to buy this loan. And now we're in, I got to guarantee your loan if you're going to do the business. I think, that's initially going to be the reaction that should happen, right? But if you think about it from a seller perspective, it's not really a bad thing, right? Because if you are co-guarantoring the loan. You'll get access to the financials as things are going on. You'll know about the business operations. And then at the worst, if you see things going downhill, you just come in and seize the operation back. And then you just run. Obviously, you don't want to run the business, but it's better than trying to sell off a carcass or something like that. Or you being on the hook for an entire loan and now there's no business to pay it back with, right? So you have to see that.
That's a really great point.
Yeah.
So I have questions about that. So on one hand, I could see how it would be terrifying as a seller because you don't want to be on the hook for it. But I guess the way you could circumvent that, navigate it, is put some type of language. And I'm not an attorney. I'm not saying, I'm just speaking out loud just in terms of me understanding this. But you could put some type of language in a contract to just say, hey, if things start to go south, then I could basically take the business back or work out some type of deal to where I could, I don't know, not be on the hook for it with the SBA. I don't know how it would work with the SBA, but there has to be some way to put language in there to try to cover yourself, right? Because what else can a seller do to prevent being on the hook? Let's just say it was an inept buyer. Let's say the business was intact. I sold it. The buyer tried to come in and run it. They didn't run it as well as me, but now I'm on the hook for the loan as a seller. Is it's just a tough spot to be in.
Yeah, very tough spot to be in, which puts a lot of diligence on the seller's kind of vetting process, right? And that's good because you'll also have an intermediary that you're working with. You got a broker that you're working with and some other team players like a CFA or whatever who helps you through the deal. So I would, you want to make sure you circle up with those professionals and have them render a valid opinion on it too, in terms of, the viability of the seller, things like that. But I think that opens the door also to a lot more creative financing, or if you can get the seller to be confident to not maybe have to go through the SBA, you can get a seller note where it's between you and the seller, and you can pay them off if they'll do that. Or just negotiate the price, right? So you just have to, the seller will probably be more willing to come a little bit more off the price if you can do a deal without having them to have locked up for a couple of years. So it does open some opportunities, but it does close a lot of doors too, because only 23% of sellers want to offer any type of financing package as a result, right? And so imagine it's even less that have any equity rollover. It's probably in the 10% that want to roll over any equity. I mean, even with the deal that I'm doing, seller started off that he was cool, and now he doesn't want to have to personally guarantee the deal at all, which worked out to our advantage. We're not getting a better deal as a result, but everybody's going to be able to willing to do that. And so just something to take in consideration as you're looking at it. But the thing is that, with the buyer pool evolving, job security weakening, and a lot of professionals trying to seek and get into these businesses. The thing I'm wondering about is, will they really be able to evaluate a good business? I mean, a lot of people are like, I did, accounting in corporate, or I know a little bit about this. Let me go out here and buy this, restaurant. and I get, I always wanted to own a bar. Let me go buy this bar, right? And so, just will they be able to really evaluate a business on a good level before they go out and take a risk? Is what I'm wondering about too, right? But the other last couple of points I just wanted to touch on too is that the opportunities in the market, like things that you may want to look at, right? So retail and service businesses right now are just, I'm sure you've got some really motivated sellers in retail and service businesses just because of tariffs, all the uncertainty. People have been doing it, so they're probably pushing up their retirement plans or are just looking for anybody to come buy this thing off their hands so they can get out. So you can probably find a good deal there, but just because the price is good doesn't mean it's a good deal, right? The business could have been worth $400,000. Seller's like, hey, just give me 200. I'm ready to go out of here. And that still could be a dud for you. So just be careful with that. Recession resistant plays are going to be a little bit tougher to get into, I think, because a lot of private equity firms are looking at those right now. Manufacturing companies has always been one of the things I've dreamed of acquiring, but just been more dreamed than reality for me. But tariffs are really crushing them. So the margin, we have to really look at the margins when you're looking at those. In restaurants, I just never liked restaurants, and really now restaurants are even more. I think just getting squeezed is probably really tough being a restaurateur right now. So just, you want a dependable partner, not the one that's high maintenance, unpredictable. In this market, cash is king. So you're looking for something that's cash flowing. Don't look for growth right now, as growth is going to be, unless you're in like AI chips or something like that.
But what industries do you actually like right now? Because everyone does gravitate towards like the recession resistant or recession resilient type of businesses.
Yeah, healthcare, logistics, transportation, construction, things like that.
Yeah.
Retail, like I said, retail service businesses will still be good. It's just, I just come in there and be ready to like really go over that thing. Because typically in a deal, you just want to look at like the salient points. You're not going to catch everything. But with the retail business right now, I just spend a little bit more time digging through the numbers than I would have typically if I was going to look at one of those, because you really want to understand the pricing points, right? So you want to understand where they're buying from, what the source materials that the person they're buying from is getting. You just really want to understand your supply chain, because that's where you're going to get crushed if you don't understand that supply chain, because something could just change and you're out of business because you can't, get enough inventory, or the price has gone up. You can't pass that along to the consumer, and you're just out of it, So just understand that supply chain. But just in hindsight, kind of last steps for takeaways, just right now in this environment, typically you go to look at a deal first and then go line up your financing. I'd say flip that around. You want to go out and start talking to the banks before you even start looking at sectors. Go talk to if there's an SBA financing, call up some SBA lenders and say, hey, I'm looking at deal. I want to look at deals in this sector. Is that something you guys are looking at right now? You want to have that lined up before you even go to the buyer, because the buyer, like you said, they don't really want to offer financing right now. And if you're not going to be able to get an SBA lender, you might get a buyer to agree to sell it. But if you can't get a deal done with the SBA side, it's done anyway. So you're just wasting your time. So I would start there first right now. And then, as I said, pulling up, man. Just right now, if you're trying to go solo, you can probably still get some stuff done, but you're not helping yourself any favors. So if I was you, try to find some other people who are looking to get into it too. Say, hey guys, let's pull up together and let's put our money together and go do some deals. Because trying to go solo, not only will it give you a better profile with talking with the seller, but you won't, in this bidding environment, when you do get a good deal, you're going to be coming up against other buyers. And so you want to be able to do more than just come to the money with money, come to the table with money in your hand. You want to come and say, hey, we've got 3 guys and we all got expertise. He's got marketing. I've got finance. This guy's got operations. We're going to be running a business and leveraging that, versus you coming and you just did some, mid-level management at a corporate level or something like that. That will kind of help you out, as cash isn't enough to do it on a good deal anymore. And again, target the right sector. So
it's good stuff. Good stuff. When you say, last question, when you say I think it's a brilliant idea to flip it instead of just looking for a deal first. Like, actually go about trying to line up your financing,
Mm-hmm.
what are the steps for someone that's listening in and wants to know that without having actually done a deal? Because the first thing I'm thinking, the bank or SBI, whoever is like, okay, well, give me a deal and let's talk about it. It's like, well, I want to establish a relationship. I want you to, know a little bit more about my background and what I'm trying to accomplish so I can build that bridge. So when it's time, it's already established. So what would you say to someone if they don't necessarily have the deal? Like, what are the steps and how does that work? Like, what does it look like in terms of actually establishing that type of relationship to seek the financing?
With an SBA lender?
Yeah.
Yeah, it's just, yeah. So yeah, it's going to be, yeah, it's going to take some elbow grease. You're going to have to go look for your local banks or call a few banks around. Then you got to try to trace down the SBA team. Then you actually got to get them on the phone. But it's good that you do it now so you'll understand later on what you'll have to go through anyway. But the other thing is just really because you want to be able to go to that transaction and talk to that seller who, only 23% of sellers want to offer any type of financing, and even less would probably want to give you any equity rollover in a deal where they'd have to co-sign the loan. And so you're going to come to the table, more than likely, if it's a decent deal, there's going to be at least 1 or 2 other buyers who are also kicking the tires on it. So it's going to come down to a competitive process possibly. And so if you can come to the table and, as I said, you just want to bolster the positives on you. Say, hey, I've already talked to an SBA lender. They've, given me a green light to move forward with deals like this. That I think would give you an edge. Not saying it's going to guarantee the loan, but it gives you a stronger chance of winning that particular deal. And, you want to talk to the SBA lenders and just have, if you want to focus on restaurants or retail stores, you call the lenders and try to find the lenders who are lending to restaurants or retail stores, because not all lenders are going to be the same type of appetite. And so you want to find out who it is, kind of see what kind of deals they're looking at, what they're looking for. And in that way, you kind of have a framework to know if it's going to fit in that wheelhouse before you go talking to the seller, instead of finding out on the back end and it doesn't work out for you. And then, now you just wasted everybody's time, and it makes you look bad in front of the broker. He's probably not going to see any more deals or be reluctant to send you anything if you come back to him again. So you just want to have a good reputation, because this buying market's small. But yeah, so I guess at this point we'll switch over to the real estate market. We want to talk about some recent wins that Welfare had. And then as you buyers are navigating it, I'm sure you've got some questions that would be on bested strategies that you need to employ right now so you can be in position to win. So Welfare, you recently closed a new deal. Talk to us about it. What's the size of it? What made you settle upon it? How did this come about?
Yeah, man. Thank you for that. Yeah, has it been a month, 2-3 weeks? Yeah, so close on another property, and I actually had one under contract back in June, July, and the deal fell apart. So I can briefly talk about that before I got into this next deal. But the first deal I had under contract around June, July, and everything was all set. Like, I ran the numbers on it. So my buy box, I'll briefly say that. Talked about it a lot on the pod, but my buy box is, smaller submarkets, single family homes, 1,200 square feet, ranches, so 1 stories, preferably brick, 4-sided brick. So starter homes, or homes where, smaller families typically live. I mean, it's welcome to anyone, but that's just in my mind of what that home, they used to build those types of homes for back when they were building a lot of those that size. But prices, $200K or less. 200K or less. And yeah, just other things in the buy box, which we can talk about later if we want to go into more detail about a buy box again. But anyways, found the deal, negotiated it, got it under contract. We're all set. Like I went through underwriting, got all the way to a week before it closed. And the issue was there was a resident that was living in the property, and the seller just never sent the why am I forgetting the name? The lease, sorry. They never sent the lease. So I was working with an agent and it was going back and forth with the agent. And for whatever reason, I guess you can make the argument of, hey, you should have just canceled it during due diligence. But operating in faith of they keep saying they're going to send it, but they never sent it. And so it just got to the point where my agent called me a week before closing. And they're like, hey, I think you just need to pull from the deal because something is up. The seller's not being forthcoming, and that's always a bad sign. So I didn't want to be in a situation where there was someone residing in the home and they did not have a lease, and it would basically be like a forced living situation, and then have to potentially go through like the eviction process and anything like that. But so walked away from the deal. I had done an inspection. I had done an appraisal. Like I had spent like a couple thousand on the deal, but thought it was better than potentially losing more with a situation where we might have to evict, or it could have been hostile and have to try to make repairs and all that stuff. So shortly thereafter, because they had already done all the work, had already gone through underwriting, it's just a matter of finding another property to like shoot through for your deal. And so I found this one, and we were able to close, I think, in like 2.5 weeks because all the work had already been done. So we just needed to negotiate, and luckily came in with the asking. We got in at like 10,000 less than what it was listed for, but then it appraised. So we got a little bit of equity on the deal. And now we're just trying to get the home ready for residents. So we already have it posted, and just trying to get the repairs done. So should be in a good spot, man.
Should be in a good spot, trying to get the repairs done. So interesting. So did you know fully the extent of the repairs before you were able to close, or was that some stuff that came up afterwards?
So the way that, great question. The way that I try to run all of the properties that I purchase is I get an inspection report regardless. I do it for a myriad of reasons. So one, I just want to know the condition of the property. Like I want a professional eye coming in and telling me what the actual problems are. And then if it is significant, like roof or foundation or HVAC or plumbing or electrical, things like that, those are serious and they have to be addressed. Well, if it's cosmetic, then, I just kind of go ahead. But if it's something major, I try to go back and if it's too severe, I might just walk away from the deal. But if something I think it can be remedied, then I'll just go back and try to negotiate with the seller. So it ends up usually being like a negotiation tool more than anything else, because probably I like the property enough to keep going, unless it's something that I found was really terrifying on that inspection report.
Okay. Now, and notice that, there's been some reports about kind of rents. It's been a big talk lately on different real estate sources, right? And so what is your kind of strategy or thoughts around rent stability for your property? I mean, do you feel like you're going to be able to maintain the level of rent you're charging? Do you feel like rents are going to come down? Do you feel like you'll be able to raise rent on this tenant pretty consistently? What are your thoughts around that? Did that impact your decision in this any way, or?
Yeah, it did for this deal. So everything I feel like is volatile right now. And even in markets where you feel like rents are appreciating, you just never know. You can never be overly confident because your product can be good and you still may not necessarily get the results you want. And by product being good, I mean the home may be in good condition. You may have, shown it well or had some really great photos, or it may have some cool features that other homes may not have, is what I mean by that. But there was a level of contention around how much we thought we could potentially rent it for. So my rental strategy is always, I look at what the market rents are and I try to be just a little bit less than that because one, I do want, fair and affordable housing. And two, that people are inclined to not necessarily pay top dollar for whatever the rental rate is at the moment. So that just brings more eyeballs and more attention to like the property that I'm trying to get a resident for. So with this one specifically, I ran software on a couple of different platforms and they were all coming in around the same price, but I always check with like a property manager that is local to whatever property that I'm trying to acquire. And they told me that they thought I would end up getting like maybe 200 less than what we ultimately listed it for. So we'll see. I haven't got an executed lease just yet, but I think we're going to be able to get the rate closer to what my software said, not what the property management said. So sometimes property manager may know more about the area. They may actually have properties on the same street, but just never know. And so some of it is a gamble in terms of you don't know what you're going to get. You can do your due diligence the best way possible. But the only way to really know is put it out on the market and let the people decide.
Put it on the market and let the people decide. Okay. Well, that's interesting that you say that because, in the markets that some of us know dear and true to us, and I know a lot of the cities downtown, I mean, they're talking about these new apartments that are going up where rents are like $2,000 just for like a 1-bedroom. Mm-hmm. And these are like cities in the South, like Atlanta, like I think Nashville, Miami's already been way up there. I mean, this is stuff we were talking about in New York. So I guess in terms of like migratory patterns or something like they see that, do you see, I guess, more people going to start and I guess maybe that's probably the best place to start is what type of tenant do you think you're attracting for these type of properties? Is it like a mother or is it a family? Is it like a young professional? Who's the type of tenant that you're trying to attract with this that you think would likely rent?
Well, and just in terms of just the way that we approach renting is like we don't necessarily try to look for like a archetype. It's really just more so, do we think that the home is in good condition? Do we present it well? Do we think the rents are competitive? And then whoever, has interest, then that's whoever has interest. So we're a little bit more, I guess, agnostic when it comes to that. It's like, one, that's fair, safe, and legal to do it that way. And that's just our approach is, whoever has interest in renting, then, that's what it is, as long as they fit like credit guidelines, income guidelines, can you, pay the deposit, like those types of things. Mm-hmm. Like when are you looking to move in? Like those are like more of a concern versus like your income and like how you earn your income and that type of thing.
Right. Okay. Well, I guess I say that because I saw some reports this week where shout out to Reventure Consulting, where a guy was going over just basically the surge and demand of new luxury apartments, right? Which is the ones downtown I was referring to. But on the contrast, typically a lot of young professionals are the ones running these apartments, right? But as you and I know, the demand for these professionals, they're not getting these jobs coming out of school. So they're the highest unemployment rates are among, recent college grads. And then you got collapsing immigration, kind of weak job market for college graduates. So I guess the thing you're trying to get to is this just a temporary blip? Is it something, a shift that's happening in the market? What is, I guess, the strategy around that, or is that, do you think that'll have any impact on where you're playing at or not?
Yeah, I got you now. You're saying like a ripple effect of like rent being expensive here. Will it pour out to other markets type of thing?
Or will they even soften now? Because the demand's got to come down if, there's just no new recent college grads.
Rents are definitely
out.
Yep.
Yeah.
Yep. 100% agree. Now, as you said it best before the pod, is like real estate is hyper local, which is true.
Yeah.
So what's going on in a major, like top 10 DMA is going to be different than a city that's 2 or 3 hours away from there, right? That's not even considered metro. Mm-hmm. But it's all connected, but at the same time, it's like what you're experiencing may not necessarily have any blowback or blow over. It's just like every property I own has gone up except one. And the one that I own is not even in the state that I live. And so it's just a product of what is the population? What is the employment in this area? Like, what are the attractions to live there? Are there any employers that are announcing that they're going to be in this city or come into this city or this area? Or people always talk about like being near schools or what type of schools, or are they schools with certain program that my kid wants to be in? Or, it's a lot of different considerations people make when they're looking to move. Is it close to work? Is it close to my family? Is it close to my friends? Like, is it close to the beach? Is it close to this office? Is it close to the concert hall? I'm just making up things, but so long story short, to answer your question, is it sustainable in terms of like the rents? It's like, yeah, it's high and it seems high, but I also have lived enough life I remember when rents weren't $1,000. Mm-hmm. And so that's completely foreign now, but it's like, well, am I just holding on to like old expectations of the way things used to be, or is this just like the new normal and we're just going to keep going from here? It's really hard to tell.
Okay. So you're saying your strategy is based on price appreciation primarily. Rents is, just to help you pay the mortgage, not necessarily for income. You're betting more on the price appreciation is.
No, not necessarily.
No, not necessarily.
I would say I would have purchased in different areas. If I was focused solely on appreciation, I would have purchased in different areas where I thought I would get more appreciation. But the thing is with the appreciation is that's a gamble in itself. But now we can go down a rabbit hole in another pod about what they call forced appreciation, which you go in and make repairs to the property and then you go get, you basically fix to rent it and then get an appraisal after you get a resident in there, and then it appraises for more, and that's the forced appreciation of it. But like playing the game of unless you're in like Cali or certain spaces where it's had a long tradition of appreciating, is like you just kind of rolling the dice versus you have a good idea what rents are going to be. Mm-hmm. And so as long as, the mortgage is getting paid, you'll be safer to not lose your shirt versus you buy a deal and it's not cash flowing and it's not appreciating. You're in a real pickle.
Yeah. Yeah. And that was what I was trying to understand is, okay, so you're basically, you're buying an income asset and you're counting on the cash flows to cover the mortgage. So I know you do analysis on what the rent can be and what your break-even point is and things like that.
Yes.
But I know a lot of investors, even, with the business, right? There's a point where the market reaches kind of an ATH, an all-time high, so you have a retractment. And so I'm just curious if you feel that if, some of these people are maybe buying in anticipation that rents aren't going to pull back possibly. And if they do, can people withstand that without it, coming to have to unload the properties prematurely or force, unloading, or just kind of your thoughts on that?
How well did you underwrite your deal?
Yeah. Okay.
Right. So if you buy a deal, let's say it's 100K, and the rents, and it goes back to 1% rule, rents are 1,000, right?
Yeah, rents are 1,000, and then let's say they go to 850.
Yeah, let's say rents go to 850.
What percent of buyers can withstand a 10%, 15% reduction, do you think?
So that goes into it. Okay, so I'm going to answer it with the question. I know you're not going to like that. But when did they buy it? How much did they buy it for?
How much? In 2025.
Oh, they bought it this year?
Yeah.
Okay. And then what is the mortgage? What is the all in? What are the expenses all in? Like, is it less than 850? Like, because how did you underwrite your deal? Because you have to have some margin of safety in there.
Right.
So if you, in my mind, the way that it should probably work is it's 100K, it rents for 1,000. Your mortgage should be 750, 800. And so you have a $200 like margin, right? And that's including all in, right? So let's say your mortgage is 7 something, and then your insurance, all that stuff. Let's just say hypothetically, I didn't do any math, but let's just say it comes in at 800. You still have a $50 margin. I mean, it's really thin, but
really
at least
you're still surviving. You're living to fight another day. And that's what we're just trying to understand is, can people live to fight another day or not? And
how are you underwriting your deals?
Okay.
That is what it all boils down to. Because if you're getting rents of 1,000 and your mortgage is 1,000, you are upside down. I can assure you that. You may have property management, you still have insurance, you still have taxes, you might have lawn care. Something's gonna go wrong. Like, do you have any cash reserves? Like, man, you're just flying close to the sun,
Right. Yeah. And that's the thing. I mean, they got a mess. It's a mess, but it's not really a mess, right? Because a lot of the press they cover about why people are staying in place, right? Because I got a 2% rate, and rates right now are close to 7 or 8%. Right, so I'm not selling this house because I got a 2% mortgage. Doesn't make sense.
Golden handcuffs.
Yeah. So you're handcuffed in. So really, it's more of a policy issue, I think, than them cutting the rate down to, because they're not going to cut rates down at 2% unless something's really bad happening. So even Powell cutting these rates coming up here isn't going to do it. So really, it's just a supply, and then also even the supply. So it's really just a supply issue. But I think what nearly needs to be done is they're just going to have to go and kind of run the corporate money, like the Blackstones and people buying up a whole neighborhood and renting it out to people. That stuff's going to have to be done at a policy level in order to do any kind of somewhat of a correction to get this thing kind of normalized. Otherwise, I mean, I don't know. It's just crazy market. I mean, they're building so much rental inventory right now. I just wonder, I just wondering, ultimately, what gives,
Yeah, man. I don't know. I mean, I've heard rumblings of legislation is going to change and like limit how many single family homes you can have, or there might be some special taxes that you'll have to pay if you own a certain number of properties. And so I really don't know, but
yeah, but that hurts like small invest. Well, it depends on, what the threshold is, but
yeah,
that hurts small investors more than it does the large one. I mean, it can run a little tax and write off or do a loophole or arcane, put it in a different kind of vehicle and roll it up a different way. So there's just so many ways that they're going to avoid that.
They're going to,
laughable. And it really puts them at an advantage. So in the interim, I guess the answer is, I think you're in a good position, right? As a real estate investor, if you're buying a property, rents are probably going to yin yang, but over the long run, it's such a mess right now that the appreciation is pretty much locked in. You're going to be okay, unless they start just building some type of I don't know. But the thing that does concern me though is these build to lease, rent to lease neighborhoods though.
Yeah.
Like I wonder, would they overdo that? Because they're just popping up. There's a lot of those popping up. And that could, if that doesn't get absorbed like it should, then, what happens then? So we'll see. It's interesting times. But overall, I do think, as a real estate investor, it's never been a better time to do it because you pretty much got a floor in what you're doing. So
what do you mean by that? Like a floor?
Well, just that, prices aren't going to crash like they did in 2008. There's no black swan event where people are doing, credit default swaps or financing things like that. That's going to cause a big crash in the market. Don't think that could probably crash. The only black swan event would be like if someone came in and said, all right, no private equity at all. You got to sell these houses or else you're going to get paid 200% taxes on it or something like that. And then they have to sell every last property in one fell swoop at a fire sale. Then, maybe that. But even then, I think those properties will get bought out by other smaller 100% people who are ready to go move or whatnot.
100%.
So that's what I'm saying. I think you're as a real estate investor, even though we don't give financial advice on the show, I think you're in a good shape. So,
well, that's encouraging. I will say, as a person that's buying properties, it doesn't feel so safe. So that's it's still riddled with error and riddled with risk. So you saying that makes me feel a little bit better, but you just never know, man. Like anything could happen. You just never know.
Well, yeah, granted, you have something could go bad on a property, you have to fix it. But over a long run, I feel like the long-term appreciation trend will hold. Mm-hmm. You got more upside than downside risk. Okay,
that's the goal.
For now, things can come around and change tomorrow with stroke of a few pins, and then all bets are off. So, but for now. All right. So, but anyway, we'll stop here. That's another episode of Point of More Returns. We want to thank you all for joining us. We look forward to speaking with you again next month. Have a good one.
Yep. See ya.